Good morning, everyone. Thank you very much for joining today. Another warm morning. Hope everybody managed to get some sleep over the very hot evening last night. Um, Realize it's half term as well, so we're just going to hold on a minute. Just let anybody in that's just reaching for the coffee, finding a quiet space at home potentially to join. So we'll just hold off for a minute, and then we will get cracking on today's webinar focusing around revenue changes. So just bear with, get a glass of water if you need. But yeah, we'll just hold off for 60 seconds. Right. Go on then. We will start. Time is, as ever, quite pressing on these things. There's a lot to get through. Um, Thank you for those that have joined previous ones. We've done sort of a number of these now, looking at the changes in FRS 102 and the potential implications. We have done a sort of high level look at some of the key changes coming in, touching on revenue, touching on leases, and some of the other sort of pieces, thinking about some of the practical areas. We are going for a bit of a deeper dive today, focused on revenue. So my name is Dickon. I am an audit partner at HW Fisher, part of the Summer Group. So I am based down in London. My sort of background has been across owner managed businesses, full lists down to small businesses, plus a degree of not-for-profit as well. I spent quite a lot of time doing the changes in IFRS 15 and 16, and this is what FRS 102 has been changed to align to. So today we're going to specifically focus on the revenue. As ever, there's quite a few slides. We are going to just try and rattle through in the hour. Please do add comments and questions in the chat if you have them. If there is time, which again, unfortunately, these tend to run the hour. We will get to them. If there's not, the team and I will pick these up and we will respond to you separately. The slides will be, if some people have to dip out, the slides will be available online. The recordings will be there for those that stay the full course today. There will be CPD certificates, as we'll be able to demonstrate that you've done your hours learning, which is always helpful for ACCA, ICAW, or otherwise. So expect those. Those will be emailed around as well. So without further ado, we will talk about FRS 102 and revenue. And what does that mean? That's the buzzword that we will forever talk about, at least for the next 12 months, which is applying the 5-step model to revenue. We are going to be looking at that. We're going to go through some worked examples on a few of those steps to try and bring a little bit more clarity, go into some of the areas where potentially high level you might have thought doesn't impact me, try and pick out some areas that might create a bit of change, might be in need of a little extra thought. So these are now in effect. They were in effect from the 1st of January 2026. So for year ends 31st December 2026, that will be the first year applying the new FRS 102 revenue recognition methodology. I think the key, as ever with these, is don't leave it too late to consider the impact. There are a number of things to think about, not just what the accounts will look like, what the disclosures, the policies, all of those kind of things that will need some thought. There are potential wider impacts that we'll talk about, and impacts on different stakeholders that you just need to think about. And actually, if you leave it all until December, you leave it all until, you know, January, February next year, and thinking about it retrospectively, you might miss something. There might be some impact. So do start thinking about it. Think about, you know, your finance team, what you've got. Have you got capacity? Do you need assistance in looking at it? You know, there is some time, there is a lot of judgment in a number of these, so it is going to require a bit of work. So the overview of the 5-step model, as I say, IFRS 15 was changed 8-ish years ago now. FRS 102 looking to align with IFRS counterparts, so make it more consistent to readers of accounts. This has created the change. We will look at the 5 steps. In summary, those 5 steps: identify the contract with a customer, identify the performance obligation in that contract. So what have you promised the customer? Determine the transaction price. What is the promise, and how much are you charging for that promise? And then allocate the transaction price to promises in the contract. Now, this is key. This is the idea that you know, you might now have made more than one promise within your sales, so actually you've got to unbundle them and allocate the price accordingly. And then step 5, the seemingly the easiest piece, is obviously recognize that revenue when you have satisfied the promise. So it's either over time or a point in time. So 5 steps. As we go through this, we will see that some of these, you know, it could be, you know, super vanilla and not a huge amount of fundamental change if you've seen it in a real sort of basic transaction. But there are potentially quite a lot of trip hazards or other pieces that just need to be thought about and worked through. So when we are in step 1 and identifying the contract, that is potentially a physical contract or an implied contract. This is not the expectation now. FRS 102 is asking everybody to draw up a contract, get your lawyers involved, and have a contract for every transaction. But the premise is now, you know, revenue is now considered as part of a contract. There is a contract implied or otherwise that is now involved between the customer and you as the potential seller. So what does that mean? How do we identify that contract? So contract has been approved by both parties. It's got to be mutual consent entered into that contract. Both have got to be aware of it. Each party's rights can be identified. What are you selling? What are you buying? You know, can you identify that within that transaction, in that contract? The payment terms can be identified, so we can, you know, see, you know, what we're paying and when. The contract has commercial substance. This is quite important. You know, just some things, there's got to be a reason why we're selling it. You know, if it doesn't meet that commercial contract, it possibly isn't revenue and should be dealt with elsewhere. So that one's, you know, quite an interesting one. Might not happen huge amounts, but it's certainly worth thinking about. That, you know, have you got commercial substance to your contract? And then it's probable the entity will collect the consideration it's entitled to. Now, in a very sort of vanilla, simple one that, you know, I probably used in the high level overview, if you go to a supermarket and buy a bar of chocolate, you get to the till, you know, at that point in time, you can identify contracts, you know, that, you know, presenting the bar of chocolate that I'm buying, the bar of chocolate, you know, there is a sort of implied approval from both parties. Someone's looking to sell, I'm looking to buy. We can see the sort of each party's rights can be identified. I'm going to transfer money and receive my chocolate bar. We know what the payment terms are. We know what the price is, and is there commercial substance? We would assume that there is at a supermarket. So in that simple transaction of buying my chocolate bar at the till, you can easily meet that step 1, identifying that contract, that implied sort of piece. But it's working through these. It's obviously not as straightforward in other areas, thinking about have both approved, those kind of things. But step one, identifying that contract. Step two then is identifying the performance obligations. This is, where it becomes a little trickier, a little bit more nuanced. So that performance obligation is a promise in a contract with a customer to transfer to the customer either a distinct good or services, or a series of distinct goods or services that are substantially the same and the same pattern of transfer. So the key here is that distinct, you're transferring that distinct goods or service. So what does it mean to be distinct? It is distinct if both of these are met. It is sort of prescriptive on this one that the customer can benefit from it either on its own or together with other resources, and it is separate from the other promises in the contract. So it could be you have, as I say, in certain sales agreements, certain situations, multiple performance obligations. What you've got to really establish, and where the real sort of judgment and thinking sort of part here is that distinct from other goods or services being provided within that contract? Can it be, as it says, sold separately? Can the customer benefit from it on its own? And is it separate from other promises? Can you deliver just that if you had to, in a different scenario? Can they benefit from just that? So you've got to start thinking about, actually, we've committed to doing all of these things in more complex contracts. Are there specific distinct performance obligations? Could the customer benefit from it? Because then we've got to separate those out. That one is distinct. Some may be all bundled together, and you cannot separate them. But where you can, you need to start going, right, individual performance obligations in our contracts. Where this starts, getting a bit different, maybe, where we've sort of thought about sort of certain things where historically we might have thought about them differently. So non-refundable upfront fees. So where did we have this example? Well, health clubs, you might have a non-cancelable deposit. Historically, we might have treated those, non-refundable pieces as going, well, there's, risks and rewards have been passed, it's non-refundable, they've paid it, can't get it back. We should recognize it at that point. This is under our old FRS 102. This might be the way we've been considering it, going, yes, non-refundable, can't give it back, risks and rewards have been passed, we've got that economic benefit now, we don't have to return it. So that might be the way we look at it in old FRS 102. Now we've got to think about, does that result in the transfer of the promised goods or services to the customer? So that upfront non-refundable deposit, has that meant that actually we've delivered on the performance obligations, that step two that we're thinking about, or is that part payment for something that we will deliver? So actually that upfront fee is an advance payment for future goods and services, and actually should be recognized as revenue when those goods and services are provided. So in the case of a gym membership, for example, that upfront non-refundable fee no longer to be recognized there. Maybe that, that is part of that performance obligation. What have we promised? We promised to give access to the gym, for example, for a period of time, and actually you can't separate this one out because it's not fulfilling the obligation that we've sold to the customer. So actually now a lot of scenarios where non-refundable upfront fees might not be recognized when historically they were. We might have to defer that income until actually the performance obligation, what we've promised the customer, has been fulfilled and has been, completed. So actually, there are bits here that we've got to now start thinking about and sort of work through. So this is going to be slightly different to how we've done it in the past. So I think sort of just sort of flying back to that sort of goods and services distinct, both are there. So these further factors that we've then got to think about, these sort of services in the contract, inputs that combine and therefore not distinct. So what could be an example of that where it's not distinct? So that entity provides a significant service of integrating the goods and services with other goods. So during a construction contract, perhaps you can't maybe differentiate what goods and services. It's all part of one delivery, and therefore you don't have individual performance obligations. You've got potentially one or more goods and services that significantly modify or customizes the other goods, so they really have an impact. So you can't again separate them out and maybe sell them individually separately, have the rights to them individually separately, so they are entwined, and therefore wouldn't be two different performance obligations, so they are considered one performance obligations. And finally, that sort of the goods or services are highly interdependent, or highly interrelated with other goods or services. So if you were to fulfill the promise, you had to do varying parts, but actually your contract said we were going to deliver you this final item. All of these things, actually they're all part and interrelated of delivering the final goods and service. So you wouldn't be able to unbundle them. That's not the performance obligation. So these are the kind of factors we are sort of considering. You've got to then think about, as I say, we've talked about those non-refundable upfront fees, the warranties. This is potentially another little trip that we've not been thinking about what's included. Customer options, so for additional goods or services, we'll get to that. So what is bundled out? Are there certain things at the moment that are interrelated that we've separated out, or not separated out currently, that we just need to think about? So warranties, for example, where we're talking about those warranties, it's thinking about, is it a legal warranty? Is this, a warranty that we account under provisions and contingencies, or is it a warranty that's a separate additional service that we're providing? So when we're sort of seeing a sort of additional service that we're providing, it's maybe the add-on warranty, or the warranty that goes beyond that normal warranty that's required by law. If we have historically just simply included in the sale price an additional 2 years warranty for the item that we're selling, well, actually, if that's not required by law, that could be sold as a separate, a separate sort of item. Actually, that's got to be separated out. That warranty is a different performance obligation. It's not included in, if we sold the TV with 2 years warranty. Well, actually, you might normally be able to sell the 2 years warranty. That's a different promise. That's a different performance obligation, and therefore not recognised necessarily when you've sold the TV. But over that period of time that you've sold the warranty, obviously warranties, and there are other sort of parts to that where they'll still be treated as provisions. But you've got to think about now, actually, is it an additional service? Is it additional to the sort of assurance that we'd normally give, or required to give? So actually, have we actually sort of sold something new? So warranties are a little bit different now, similar to non-refundable upfront fees. So it might be that that there is a justification for it. We just got to think about it. Is it a separate performance obligation? Thinking about customer options for additional goods. So when we're sort of talking about what other things that, what other performance obligations have we maybe got in our initial sale that we maybe historically haven't really thought about? Maybe there's something a little bit sort of new and different here. It's the option that provides customers with a material right that it would not receive without entering into that contract. So the option gives rise to a separate performance obligation in addition to other performance obligations in the contract. So what we mean by this, options that may include a material right to customers include sales incentives, customer awards, so points on cards, things that you might not get. So if it is, for example, a sale of an item now, and buying that item means that actually from buying that item you could get a 20% discount on a future purchase. You wouldn't have got that 20% discount on a future purchase if you hadn't bought the item now. So actually that might sort of fit into an option for an additional goods or services that then need to be thought about as a separate performance obligation. So sorry, in that last part there is, if an option provides a material right to a customer, the customer is in effect paying the entity in advance for future goods or services. As a consequence, the entity recognizes revenue when those future goods and services are transferred or when that option expires. So this could be that, as going back to my point, if you buy an item now and I've got the opportunity now, having bought that item, that if I buy a similar or another product, I will get 25% off as long as I buy it in the next 3 months. Well, actually, a portion we are going to have to separate out. Some of that rights and obligations might be that that's providing me with a material, and I think that's an important part, a material right to the customer. If it is, an immaterial right, then it might not need to be considered. But if that material right, I've got 25% maybe future discount. Well, actually, that is now considered a separate performance obligation and would need to be recognised whenever, if as part of buying the future item, or that 3 months expires and I haven't bought it, but ultimately I've lost that opportunity now. So actually that future discount, and this is quite relevant to a lot of retailers, that's a purchase of something and then getting something discounted in the future. This now might mean a deferral of some of that initial income. So although you've paid 100% for that first product, actually what they're saying is now some of that payment is towards that other future sale, so will have to be recognized at that future date. So the transaction price. So we've got to determine the transaction price. So step one is obviously thinking about the contract. Step two, we're thinking about those performance obligations. Step three, we're now determining the transaction price, and that is the amount of consideration to which the entity expects to be entitled in exchange for transferring goods or services promised to a customer, excluding amounts collected on behalf of third parties, i.e. VAT or sales taxes, for example. So this could be very straightforward, a transaction price. My bar of chocolate has a price on it at the supermarkets. Absolutely easy to determine. I've got one performance obligation, one transaction price, one contract. I'm buying that bar of chocolate. It's probably melted in today's heat, but I'm buying it anyway. There is a price on it. I'll take it to the till, and I will purchase it. And that transaction price is there. It'll be on the barcode. It'll be agreed. So can be very straightforward. Can be obviously more complicated, some more judgments and thoughts there to be considered. So what else do we need to think about? The variable consideration. Are there differing prices depending on certain situations? The rights to return, obviously another big one in the retail industry. So what's the rights to return? Are there royalties? That time value of money, are we deferring some payments and things like that? And non-cash considerations. Is there anything else that's being sort of paid? So there could be quite a lot of other sort of pieces here. So we'll just have a sort of a real sort of look at some of these. So returns and time value of money. So that returns, So we account for the revenue for the transfer of the products with a right to return. So we're going to recognize revenue in this sort of three sort of pieces we've got to think about there. So we're only going to recognize the revenue for the products we're expecting not to be returned. Now, this for those in the retail industry, for those with, you know, where this potential returns is applicable to you, this again, you've got to really think about, you know, it's quite a judgment here. How much, you know, what is your likely percentage of returns? What likelihood of certain products returning? So there is judgments, there's estimates here that again you will need to start thinking about if you haven't already got access to or thought about maybe your historical data. What is the, you know, the general returns in any given month? Is it cyclical? Is there a difference? Does Christmas and holidays play a factor in both purchases and returns? So what does your data you know, show you? Have you got the data? And if you don't have the data, how are you thinking about returns and the likelihood of return? So that initial revenue is only on products expected not to be returned, and effectively for those other items we'll set up a refund liability for the consideration received for those not to be returned. So, you know, effectively we're going to debit our cash and we're going to credit revenue for the items we think are not going to be returned, and we're going to credit a returns liability for the items we think will be returned. On top of that, we will create a refund asset. So something in inventory is separated out, you know, area that is a refund asset in inventory for those items we think we're going to get returned. So we'll basically increase back our inventory and decrease our cost of sales for those items that we expect to be returned. So it'll now be, yeah, revenue, liability, and then a separate area for an asset in your inventory, and a removal of your cost of sales in relation to those assets that we think we'll get back. So that's your returns. But as I say, relatively straightforward. Big judgment though is what you think will be returned. How do you get comfortable with your expected returns? And if you've got auditors, you know, how much evidence have you got? How much consideration have you got? So that they can get comfortable as well that, you know, what your judgment and estimate is correct. Things to then think about: is it significant enough? You know, is it material enough? You know, should there be additional disclosures in your key judgments and estimates part of the accounts? So there's a lot of potential moving parts there on returns. Time value of money, seeing a lot more, you know, in the way people purchase stuff. Some of this might not impact you direct, might be through other sort of organizations. But if you do offer a deferred payment plan or something like that, so you're not having to pay on the day, so if that payment is deferred beyond normal business terms, or is financed by you as an entity at a rate of interest that is not market rate, then the arrangement constitutes a financing transaction. This is suddenly going to present as interest revenue. We're going to account for this and think about it as interest revenue under sort of sections 11 and 12. So you've got to factor in some of this financing, because you are effectively delaying that money, that payment to you. You're creating effectively a financing transaction there. So that will then need to be unwound accordingly, and you know, you will show that separately. So there will be, you know, two different sort of transactions. There will be that unwinding that will be shown as interest revenue. Variable consideration, we've got, you know, a number of areas in there. So discounts, that variable consideration, you know, is, yeah, absolutely, is there sort of current discounts. We've talked about sort of potentially the performance obligation of future discounts, but actually just from a consideration price now, is there discounts, rebates? You know, are you potentially if a customer buys a certain amount, do they get a rebate? We've talked about refunds, certain sort of performance obligations, bonuses, and things like that. So there could be, I suppose, variable considerations in there. So just something to think about. And you then you've got your two options. You've got your based on expected values. And you've got then most likely outcome. So they're slightly different. And you just got to, once you've chosen your method, you need to apply them consistently. So when we talk about the expected value, the expected value is the sum of probability. So it's an expected value that where do we think we're going to end up? An expected value may be appropriate estimate of variable considerations. So it could be that in this sort of an example of, you maybe enter into a transaction where if you deliver your service by the 30th of June, you will get an additional 10%. Now, at this point in time, do you expect to be able to complete it by the 30th of June? Therefore, if it's a yes, the expected time frame that you might do it is the 30th of June, you would recognize that additional 10%. You take that into consideration as a variable consideration, because your expectation is, we'll complete before the 30th of June. If your expectation is, actually, that was always going to be a push, it's a bit of a pipe dream, then you don't factor it in. If you then get there, you obviously recognize it at that time when you do it. But if you think in advance there is that expectation, yes, we're going to make this. And again, it's a big judgment as an estimate, depending on, quantity, volume, all these kind of things. So you need to be able to defend your judgments and estimates there, but that is an example of an expected value. The most likely amount is, using those rebates as an example. If a customer, you may offer a range, there's a range of rebates depending on how much a customer buys, and it could go from 5 to 10%. That's the point, is where are you going to sit? So that's where we're sort of thinking about expected and most likely, and so that's where you got your variable consideration. Step 4, allocate the transaction price. So we've got the contract, we've got the performance obligations, we've worked out what our transaction price might be. That may factor in time value of money, returns, it may factor in variable consideration. So just got to that stage, brilliant. Now we've got to allocate those pieces across that contract and across those performance obligations. So, and now we've worked out that transaction price, we allocate it in proportion to standalone, and we've got a worked example coming up on this. So a standalone selling price. So if our overall contract is sold as one, what would we sell individually, those individual performance obligations, and then allocate it out accordingly? So this standalone selling price is the price at which an entity would sell a good or service promised in the contract separately to a customer. So if you sold it as just one item, would you sell it for more than actually what each of these performance obligations in this sort of bundled agreement? So you'd look at each standalone and then allocate it proportionally to that. So you've got to think about that. Let's work a worked example on this one, because I think that helps bring a little bit of clarity to this. So that allocating the transaction price. So if I use, summertime, garden sheds, and being out in the garden is maybe what we're all thinking about. So Shed Limited manufactures, sells and installs garden sheds and lawnmowers. The sheds can be bought on a standalone basis for £8,000 or bundled with installation at £10,000. The standalone price for installation is £5,000. So if you had your own shed and someone came to install it, they would charge you £5,000 for installing the shed. But if you bought it together with a shed, you would pay £10,000. So that's what we're sort of meaning there. The standalone price for a lawnmower is £2,500. Shed Light sells a shed mower and installation for £11,000. So just sort of looking at what we've got there, you know, standalone basis, you've got a shed that would sell for £8,000. You could buy it as a shed and installation for £10,000. You could buy standalone installation for £5,000 and a standalone lawnmower for £2,500. But combined, you buy the shed, the mower, and the installation, you could pay it all for £11,000. So what does that mean when we're sort of going back? I'll just dip back a couple of slides so we can see the sort of the graphic. So we've got the transaction price. So let's assume what we're trying to then do is allocate that transaction price. So if we assume we're selling the full bundle, the £11,000, what does that mean? So we're saying, right, I've bought the mower, I've bought the shed, and I'm getting installation. I know that's happening, but I've got three different performance obligations here. I'm buying the shed. I could just have the shed. I could buy the shed separately. I know that. Installation is completely separate. It's standalone. I get the benefits from that by itself. I need that. And I've got the lawnmower clearly to go in the shed, but again, is not dependent either on the installation or the shed itself. I could buy the lawnmower. So I've got these three different performance obligations over here on the left-hand side. And we've got the transaction price. Now that transaction price is £11,000. So I've got the transaction price. How do I allocate that then to these individual performance obligations? My contract is, I've agreed the bank holiday sale of shed installation mower, it's £11,000. So that's what we need to think about allocating. So what does that mean? Well, we work the standalone prices. How much does that sort of consider? So actually, we've got 11, we've got of standalone, what would it be worth? We've got a shed at £8,000, installation at £5,000, and lawnmower at £2,500. That total, if we sold them individually, would come to £15,500. So what does that mean? The shed makes up 52% of that £15,500. The installation 32%, and the lawnmower 16%. So that if each one was sold standalone, it would come to the total proportionately. Then what is the proportion of each of those? So 52, 32, and 16% of that total 15,500. That is then how we allocated against the £11,000. We take the £11,000 and we go, right, that's the contract price. That's what I've got. That's the terms. 52% of that £11,000 I'm going to recognise, in relation to the shed. 32%, so that £3,520, that's allocated to the performance obligation, which is the installation, and then the lawnmower. That gets 16% of my £11,000. So that is how we allocate the transaction price. And that's why, selling the chocolate bar at the supermarket, very, very straightforward. Selling a sort of what historically might have been a sort of bundled sort of goods and services, how have we separated that out? Now we've got to be very much aligned to the performance obligations. We've got to think about it in a sort of prorated basis, if what would we have paid if we paid for those each individual performance obligation by itself. So hopefully that makes sense to that. And I think, there's a lot of sort of pieces in here where you just got to unpick some of, depending on the goods and services you as businesses sell, and offer. We've got to think about, what would that be and how does that look? It could be from, professional services. There are a number of sort of pieces that are sold in a bundle to a sort of a client. You might get tax, accounting, accounts. Actually, sort of standalone, you might have charged extra for each individual service, but actually combined. So you've got to think about those. From retailers, absolutely, especially those holiday sales, those other sort of pieces where we're combining in sort of different pieces. How are you then allocating the varying sort of parts to the performance obligations? There's going to be a potential huge amount here, beyond if you just sell one chocolate bar. This is the sort of step 5, the revenue recognition. So once you've allocated it, as I say, we talked about this most likely outcome. I think this is the examples that actually I gave. We've being a good accountant, I've used tax there in the most likely outcome, which is completing that goods, or that service, the contract, the sales, before the 31st of March. If we did that, then there's a 10% bonus payable by the customer. If you believe it will be meeting that target, that's the most likely outcome. And then you've got the expected value. So those are the pieces we talked about there. There are some other things now once we're sort of allocating, and I think the other sort of the part of this is allocating it out at a point in time. As well. So once you've got your most likely outcome and your expected value, that's part of those considered. And then the next part is do you recognize it when those performance obligations have been met? So it might be that if that individual, so going to our shed installation and lawnmower sort of piece, once that's been sort of delivered, you would recognize potentially the delivery of the shed. You've got that performance obligation, you provided a shed, you would deliver it at that point in time. The installation, again, once it's installed, you could do it, and then the lawnmower. So you might have those as a point in time. You might have a different situation where it's overtime, where you can't unbundle it, those construction contracts, and actually you're gonna recognize it over time, and you'll think about that input use or output use sort of methodology. So you'll think about those sort of pieces. Other areas that we just need to consider, that when we've got these, it's just I think a lot of this is maybe more semantics around what we do and what we have, but costs to obtain a contract. This is slightly sort of different. The cost to obtain a contract, it's so we're thinking about things like you would recognize an asset. So if there was incremental costs of obtaining the contract, but it's if you expect those costs to be recovered, so can those costs be passed on to the customer? Perhaps you're going to recover those costs, and they are specific to obtaining that contract. So costs of those that would not have incurred if the contract had not been obtained. So sales commissions, something like that. So you recognize that as a contract asset, and then those costs, if they would have been incurred, whether the contract was attained or not, you just recognize those as expenses when occurred. So if they're just regular day-to-day, so obviously someone that salary that has been working on a particular pitch or tender, you would have incurred those costs anyway. You can't suddenly go, right, well, I'm going to capitalize these costs of my payroll because actually those people were already on your payroll. You know, that didn't change just because you won that particular contract. Sales commissions, though, that is specific to that contract. If they hadn't won that contract, or you hadn't sold that product, there wouldn't have been sales commission. So that's the sort of slight nuance. You can't just go gung ho and start capitalizing loads of costs. But if they are specific, and you can, I think that's quite important, though, we expect them to be recovered so they can be sort of passed on as part of the economic sort of benefit. So you know, they're not going to sort of, I suppose, create an onerous sort of contract. Then you can capitalize those, and then you would amortize them over the period of time that you feel suitable, whether that's potentially over a contract life or otherwise. So there might be a bit of judgment in there as well. And obviously with any asset, you do need to therefore think about impairment at the end of the year as well. So there could be, you know, certain pits now where maybe you haven't been capitalizing, we can capitalize them in advance. So cost to fulfill a contract. So there might be, you know, so going again, an asset is recognized for those costs incurred in fulfilling a contract that were not within scope of other standards. So if the following criteria are met, the costs relate directly to that contract, the costs generate or enhance resources of the company that will be used in satisfying performance obligations in the future, and the costs are expected to be recovered. So again, when we're saying that the costs to be recovered, it's not necessarily that you will recharge all of that exact cost across, but you factor that cost into your recovery. It's, you know, it is part of your margins. You're expecting to still maintain a economic benefit from the contract. So as I say, you know, if something was, you know, inhibitively expensive and created almost an onerous contract, then you can't sit there and capitalize those things. But you know, there are then again some direct costs, some other pieces that you can start thinking about. Could I capitalize this as part of that cost to fulfill a contract? And then subsequently you would amortize it, look for impairment. Now, some of this in some ways might all be very short term. So you know, there's hypothetically would include it, and then you just amortize it out in such a short period of time. It's effectively the same as putting to the P&L at any sort of given sort of juncture. So it's got to be something that you've got to think about. But yeah, is it directly relate directly to the contract? The costs generate enhance sort of future opportunity, and can they be recovered as part of that contract? Will you get those money back? So then you can capitalize those. Then you've got to think about accumulated amortization, and obviously every asset end of year you've got to think, actually, is there an impairment sort of piece there? Contract balances. This is really accrued and deferred sort of income, but we're now sort of talking about them: contract asset, contract liability, and entity's right to consideration in exchange for goods or services that the entity has transferred to a customer, when that right is conditional on something other than the passage of time. So, you know, as I say, that sounds probably, I'm sure, familiar to a lot of people on this webinar. Contract asset really is the sort of the new terminology of accrued income. You're creating an asset, you're creating a contract asset. You know, once that that right to consideration in exchange for goods and services that has been transferred across. So you know, you'd see that as similar to your accrued income, but it's now contract asset. Contract liability: an entity's obligation to transfer goods or services to a customer for which the entity has received consideration or the amount due from the customer. So remarkably, it is that deferred revenue, that deferred consideration. So we're now thinking about these things as contract assets, contract liabilities. So have you got the right to consideration, or have you been paid in advance for goods or services that you actually owe to the customer? And then we'll think about those as contract assets and liabilities. Again, similar sort of pieces apply on consideration at year end to that of your deferred and accrued revenue. Taking a sort of a moment there, as I say, I know people have put some questions into the chat. Might have a little bit of time to look at those, but it is likely that we'll pick those up and respond to you. So please don't think I'm ignoring you, but it's just me trying to get through the slides. I have noticed, as I say, one piece where we add to these slides before we finalize, there is a seemingly a slide missing around that final revenue recognition point where I discussed a point in time or over time. So we'll ensure those are added and brought into the slide decks that we send round. So that was step 5. So we'll just run through that and recap that quickly before the end of the call as well, just to avoid any confusion. Disclosures overview. So there's quite a lot, I think, so perhaps if I recap the 5-step model, then we'll probably look at disclosures overview, and then we'll think about some practical challenges before the finish of the call, because I think there's probably quite a few sort of pieces here to think about in your disclosures. So let's just recap the kind of the 5 steps. So it's identifying the contract with the customer, step 1. This could be a physical contract, or it could be a sort of implied contract. So think about what that is. Has that got the commercial terms? Have we both parties agreed the rights, the rewards, those kind of things? So thinking about that. Step 2, identifying the performance obligations in there. So this is where we may start getting outside of our comfort zone of what we've sort of previously done. So what are the performance obligations? Can we separate out? Are there distinct goods or services? Can they be sold or benefited from in a standalone basis, or actually are they combined and you can't separate them out, and therefore your performance obligation is on delivery of all of those sort of pieces together? So thinking about those in that step 2, in that identifying the performance obligations, we now have to start thinking about warranties. Is there a separate warranty? Is that the legal warranty, that we have to have by law, and therefore, maybe you can't separate it? Or have we been giving 2 years warranty as part of that pack, and actually that is a separate performance obligation, giving them an additional service? So thinking about warranties might not be as obvious anymore. Thinking about non-refundable upfront fees. So thinking about your gyms, where we used to sort of pass on all the risk because we never had to pay it back. It was, if they didn't do anything or we didn't do anything, it was non-refundable. Actually, now we've got to think about, yes, we may have got a non-refundable payment. Have we delivered, the performance obligation? Is that linked to that performance obligation, and therefore sort of pulling it over those performance obligations? And then what about future material rights to sort of future sales or discounts? Is there something there that actually now, hang on a second, that buying now gives me access to a 40% discount on something else in the future, as long as I do it in 3-6 other months, at a time period, or just any point in the future? So actually, am I intertwined with future sales? That's quite a complicated one. That one is worth thinking about, especially in the retail world, if you're in there. So absolutely, those are some of the trip hazards, I think, from a identifying performance obligation. Step 3, then, determining the transaction price. So it could be very vanilla, but you know, there could be a number of other things in there to think about. So your variable considerations, your returns, your time value of money, you know, so think about if you got the returns, you can create the liability, you're going to bring stock back in. Time value of money, you might have a financing piece there if you're not getting payment within normal business terms, you're sort of allowing a defer of payment for a long period of time. Variable consideration, so we're thinking about rebates, discounts individually, other kind of aspects in there. So you've got to start thinking about that in determining the transaction price. Allocating that transaction price then, so that is where you're sort of doing it proportionately. We use the garden sheds and the lawnmowers are example there. So that allocating, so what individual performance obligations have you got in your contract, how are you allocating those prices? So you then do it on a standalone sort of selling price and then proportionally allocate it out. The revenue recognition, so once you've satisfied the promises, well, we'll just add in a little additional side. So that's over time or at a point in time. So if that performance obligation is met at a particular sort of point in time, you've got the lawnmower, you'd recognize your revenue there. If it is something that is, you know, continuous, you might, you know, something like your constructions, you would then recognize it over time. So that's your steps 1 to 5. A number of judgments and estimates in there. Start thinking about it now. Disclosures for your finance reporting when you get there, maybe at the end of this year or going forwards. You've got to now have more disaggregation of revenue. That's, you know, been in IFRS for a while, but now FRS 102 is wanting types of goods, services, the geography, customer sort of base, information about performance obligations. If you've got different revenue streams, you are not going to be able to necessarily just say we're going to follow the 5-step model. It's talking about what those performance obligations are. When do we think, you know, what is it, you know, what is it that the service we're providing, therefore when we're recognizing it. Any impairment losses, you know, thinking about contract assets, contract liabilities, we sort of discussed those. That's sort of the deferred and accrued income. Additional sort of pieces there without sort of reading through them all, but you know, that sort of revenue recognized in period that was included. So an opening contract liability, so you're kind of almost having to do a little bit of a net off there and demonstrating some of those bits that have come in from deferred consideration, and clearly methods used to measure performance obligations, so satisfied over time. So have you used the input method or the output method? We're going to run a separate shorter webinar on over time sort of contracts, so maybe more of that construction piece, because I think, you know, it is worth sort of getting in there what those input and output methods are. Can be quite complicated, so you're going to have to disclose those when you make those judgments. So a lot to be thinking about, and obviously that key one at the bottom, and we discussed it through the process, is are there significant judgments and estimates that we then also need to disclose? What impact would they have? Practical challenges, and you know, just to finish this as we reach 10 o'clock, impact on performance rating. So when we look at this and the high level, I'll deny everything, even though this is being recorded, if you know, if you quote me on this, but you know, the high level impact is where this impacts organizations, where this will impact you. The most likely situation is it's not going to bring revenue forward, it is going to defer revenue later. So where there are impacts on this and performance obligations, you likelihood is that you recognize the non-refundable deposit. You've not necessarily unbundled all the performance obligations, and therefore there could be ones that sort of push revenue back. So where there is going to be impact, it is most likely going to delay revenue. What does that mean? Could mean that actually your profits are going to be down, EBITDA is going to be down. What could that mean? It could impact on performance related pay schemes, you know. So again, why I'm sort of stressing the idea of looking at this before you get to the financial statements is making stakeholders aware. Does the board know? Do other people know? Do you know, loans, covenants, external sort of debt, do that know? Do your Do your staff know? Have you considered it within related performance related pay schemes, KPIs, those kind of things? Budgeting for next year, going concern when you're signing off audits for 2025 and you're thinking about your forecast for next year. Have you actually factored that in? Actually the forecast, and again, coming back to covenants where it could be really important, those kind of things really could be impacting corporation tax, but simple things of automation and setting up your systems to ensure that you can recognize this revenue, rather than doing a manual journals for all of these things. So how much time have you spent thinking about what does that mean to your systems and otherwise? So a lot to think about beyond just simply your financial statements and your reporting at the year end. There's lots of judgments, lots of estimates, and lots of potential practical challenges. Have you got the capacity to do it? You need to, do you need to start now to ensure you've got capacity rather than doing over a period of time? Do you need wider support? Reach out to your local accountants, whoever that may be. If you need more information, do reach out to us. So lots to think about. We will be running more of these webinars, so do keep an eye out over the next few months. We'll be looking to run some bite-sized ones, as I say, maybe dip back into wider pieces like overtime recognition. It's 10 o'clock. Thank you all for listening. As I say, we'll circulate the slides. We'll update it for one extra slide that seems to have gone amiss. But thanks all for joining. Enjoy your day. Hopefully get out in some sunshine at lunch.